There was a time not too long ago when Exide Industries was among the hottest stocks on the street. Between January 2023 and June 2024, the stock skyrocketed, delivering a massive 218% return. The rally was driven by optimism surrounding India's electric vehicle boom, and Exide was seen as a key beneficiary. Then came a major boost in 2024. Exide Energy Solutions Limited, the company's wholly owned subsidiary, signed a memorandum of understanding with Hyundai and Kia for a strategic partnership in India's EV market. But the momentum did not last. Fast forward to May 2025, and as of 7th May, the stock fell nearly 40% from its 52-week high. So what has changed? Why has investor sentiment turned negative? And what does the road ahead look like for this legacy battery maker? Let's explore. Welcome to Bottom Line by Crore. I'm Radhika Bajaj. In today's episode, let's decode what's ailing India's top battery maker, Exide Industries. Before we dive into what troubled Exide Industries, let's understand the company just a little bit better. Exide Industries is not a newcomer. It has a legacy spanning over 78 years, and the company is one of India's most trusted names in battery manufacturing. Its products power everything, from two-wheelers and cars to telecom towers and power grids. It holds a leading position in India's battery market, with top position in the organized lead-acid battery market. In the automotive OEM space, the company commands a strong presence in both two-wheelers and four-wheelers. When it comes to the replacement battery market, it's largely a two-player game, and Exide is in the leading position. Exide's revenue is broadly divided into two segments. Automotive batteries, which contribute to 69% of revenue as of FY24. These go into bikes, cars, e-rickshaws, and even home UPS systems. The other segment is industrial batteries, contributing to 31% of the revenue. These are used in sectors like telecom, railways, power grids, and even submarines. But the company is actually no longer sticking with its legacy business. The bigger story lies in the company's pivot to lithium-ion technology, which is becoming the gold standard in electric mobility and renewable energy storage. To lead this transformation, Exide launched a subsidiary called Exide Energy Solutions Limited, or EESL, in FY22. If you're wondering why lithium-ion, well, the answer is simple. It offers better energy density, longer life, and lower maintenance compared to traditional lead-acid batteries. These qualities make it ideal for electric vehicles and energy storage systems. Under EESL, Exide is building a 12 gigawatt-hour lithium-ion cell manufacturing plant in Bengaluru, and this is being developed in two 6 gigawatt-hour phases. Exide is investing close to 6,000 crore rupees over 8 to 10 years through a mix of debt and equity. In FY25, it has invested around 3,600 crore rupees already. That's not all. The first phase of the 6 gigawatt-hour plant is expected to commence trial production in India in FY26. The company continues to be in advanced discussions for potential orders with several OEMs across segments. To support its lithium-ion ambitions, Exide has brought in some more power. Exide tied up with Svolt Energy from China in 2021 for tech transfer and production expertise. On the demand side, Hyundai and Kia have signed up as customers, though actual order volumes remain undisclosed, at least for now. This could be a game changer. All this bodes well for the company and its future, right? But something has been weighing down the stock. Exide's performance has not been exciting for the past few years, and FY25 also continued on a similar track. Increase in competition in the market, rise in raw material prices, and slowdown in demand have been major factors for the subdued performance. Additionally, the profitability and return ratios have been under pressure due to higher capex requirements for the lithium-ion manufacturing facility and the slow business transition towards B2B, where pricing power is limited. The same was reflected in the quarterly trends in revenue as well. In its recent quarter, Q4 FY25, the company reported a revenue growth of 3.7% year-on-year, led by double-digit growth in the two-wheeler and four-wheeler replacement segments, along with a strong demand in the solar and industrial UPS segments. Still, these green shoots weren't enough to significantly lift the full year numbers. The growth in revenue was largely offset by a slowdown in auto OEMs, telecom and the home inverter segment. Further, as per the management commentary, export demand has remained weak, primarily due to weakness in industrial demand in Europe, and that's led by the ongoing slowdown across that region. Margins also took a hit, dropping to 11.2% in Q4 FY25 from 12.9% last year. And this was largely due to rising input costs, especially lead, and higher interest expenses. Even for FY25, the margin fell to 11.4%, down from 11.7%. While the increase in raw material prices, especially prices of antimony, which is a semi-metal used to enhance the strength and durability of battery components, had been a pain point for the past few quarters, in Q4 FY25, the company has taken 3 price hikes in the past 4 months to pass on the impact. Beyond operational issues, Exide Industries also faces heightened competition. This is not only in its core business but also in the new verticals like the EV battery investments. For instance, Amara Raja, its biggest rival, has been ramping up its own EV battery investments. Here's a quick head-to-head comparison. So while Exide is larger by market cap, Amara Raja is going more aggressive on capacity and investment. Another concern is the capacity utilization risk. India's EV battery demand is expected to touch 60 to 65 gigawatt hour by FY30, and Exide is building a 12 gigawatt hour lithium-ion plant. This, along with all the planned manufacturing capacities in the market, could lead to a significant underutilization of capacity. The real test will be whether demand lives up to expectations. If it doesn't, the risk of massive underutilization looms large. Exide will need to navigate that risk, possibly by targeting exports or expanding into non-EV segments like energy storage. Also, lithium-ion cell manufacturing is a low-margin business globally. Exide's greenfield facility, built from scratch, will take time to stabilize and scale, which could drag on returns. Also, most domestic passenger vehicle OEMs already have their own lithium-ion plans or tie-ups. So Exide's addressable market is limited. Addressable market typically refers to the revenue opportunity available for a product or service. Now add to that slower than expected EV adoption, competition from OEMs with in-house battery plans, and limited visibility on order volumes. That said, the situation is not all gloomy for Exide Industries. The lithium-ion story is still Exide's biggest growth lever. The ecosystem around it is evolving and government support is building. The centre has announced 3,760 crore rupees in viability gap funding for battery energy storage systems. Basic customs duty has been waived on key battery materials like cobalt, lithium-ion scrap, lead, zinc and other critical minerals in the union budget. This matters because battery makers often rely on recycled lithium, cobalt and nickel. With import duties waived off, production costs could drop significantly, making domestic battery manufacturing more competitive. Exemptions have been extended to 63 capital goods related to EV and mobile battery production, which would also benefit players like Exide Industries. Apart from the company's side, the replacement battery market remains strong, with Exide leading the market. The solar battery segment is likely to benefit from the Surya Ghar Yojana rooftop solar targets, and industrial battery demand is expected to recover as infrastructure spending returns, especially from the government side. So while the core business does offer stability, the re-rating trigger for the stock will depend on how well Exide executes on its lithium-ion plans over the next 8 to 10 quarters. This business carries both high potential and high risk. Execution, scale, demand and profitability will be the 4 big watch points going forward. Until then, the company's performance is likely to be under pressure. So what do you think? Can this 78-year-old giant power through the disruption and remain relevant in India's electrification story? Let us know your thoughts in the comments, and of course, for more such insights, subscribe to Bottom Line by Crore.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.